Hello, I'm Damien, welcome to my channel. In today's video, I'm going to take you from complete beginner all the way to making your first investment. And I promise you, it's really easy. All you're going to need is an internet connection and £100. And by the end of this video, I'm going to give you my opinion on the following: what to invest in, where to buy it, and how you should look after it going forwards. If at the end of this video, you're happy that I answered those questions, consider subscribing because I post here weekly. So first question, what to invest in? Any ideas? I'll take that as a no. Saying what to invest in is a little bit like saying, what shall we cook tonight? It's a very broad question. When considering what to cook for dinner, a lot of the time, individuals will take inspiration from some of the best chefs in the world, log online and look at a recipe. Well, in the world of investing, a guy called Warren Buffett is the best chef around. This is Warren. Now, while I'll go into his investment strategies in more detail in a separate video, there's only really two things that you need to know about this guy at the minute. Starting from nothing, he's amassed a personal wealth of over $80 billion. 80. And if you've given this guy $1,000 in 1964 and let him hold on to it, he'd be giving you back $10.5 million today. Wow, this guy knows how to cook. Lucky for us, he's very clear on the recipe he feels investors like us should follow, as you can see in this recent interview he did with CNBC.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million.
From this, we can see it gives us two pieces of advice. The first, invest in index funds. The second, do it for the long haul. What is an index fund? Let me answer that for you. Have you ever heard the term, don't put all your eggs in one basket? Well, imagine your money is the egg and a company is the basket. Let's say I wanted to buy Coca-Cola shares and I only bought Coca-Cola shares. I'd be putting all my money in that basket. So if Coca-Cola ever did badly, my eggs might get smashed. An index is a group of companies. Now, they could be grouped together based on their sector, i.e. they could all be technology companies, or they could be grouped together just based on their size. They could be the biggest companies within a country. An index fund is a way of buying all of those companies at once. Think of it as a basket full of baskets. So if you buy that basket full of baskets, if the Coke basket does badly one day, it doesn't matter because the Apple basket is doing well. So again, just to confirm, an index is nothing more than a list or group of companies grouped together based on maybe their sector or where they're geographically located or even just the size of them. An index fund is a way that you can buy all of those companies at once by purchasing one product. A lot of indexes have fancy names that you're probably familiar with. You probably just didn't realize what they were until this point. So for example, the S&P 500. All the S&P 500 is the 500 largest companies in America. You could probably name a few, but it includes companies like Microsoft, Apple, Google, Visa, Disney, Johnson & Johnson, and a whole load others. But essentially, again, just the 500 largest companies in America. In the UK, we have our own version. It's called the FTSE 100. And all that is the 100 biggest companies in the UK. In that index, or in that list of companies, are the likes of HSBC, the bank, Diageo, who make Guinness, BP, the oil producer, or Unilever, who make household consumer goods. If I bought a FTSE 100 fund or tracker, you can call them either, I'm essentially buying shares in all 100 of the largest companies in the UK. Meaning when I buy that fund, I'm diversifying across lots of different businesses in different sectors, all at the same time. When it comes to point number 2 that Warren mentioned, investing for the long haul, I just want to play you this short clip from the same interview.
Of all the things that have happened since 1942, we've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things.
Thanks again, Warren. The point that Warren's making here is that businesses and ultimately economies survive short-term events. When you buy a fund that tracks the performance of the largest 500 companies in an economy or the largest 100, you're not making a bet on a single business. You're making a bet on the economy as a whole, essentially betting that that country will continue to grow. Warren's point here is that throughout his life, the markets have been rocked by these events. And it's those who have stayed the course who have prospered in the long run. Anytime the markets are impacted by something in the short term, I always try and ask myself one question. Do I think this is fundamentally going to change the way I live my life? Is this country that I live in going to be different forever after this? Or is life just going to get back to normal at some point? It might not be tomorrow, it might not be next week, it might not be for a year. But I'm a firm believer in the fact that the UK and America will push through any problem that faces them in the short to medium term and ultimately prosper, like they have done for hundreds of years. And while new normal may look slightly different, for example, after COVID-19, I don't think that the 100 biggest businesses in the UK are going to be wiped out by this event. Investing for the long run helps you weather any short-term storms that the world throws at the markets. These could be anything from 9/11, the financial crisis, or even this guy from his bedroom in Hounslow wiped billions off the US stock market in a matter of minutes. To put the importance of time into perspective, let's have a look at some of the performance of both the S&P 500, the top 500 companies in the US, and the FTSE 100, the top 100 companies in England, over the last 20 to 30 years. So starting on everyone's favourite search engine, all we need to do is Google S&P 500 to bring up the chart performance. When looking at this, you can examine the performance based on 1 day, 5 days, 1 month, 6 months, year to date, 1 year, 5 years, all the way up to max, which I believe is over 30 years. So Warren said in the video that the best thing you could have done in the 40s was just put $10,000 in and left it alone. So for that reason, the 1 day, 5 day, 1 month, while they are interesting to look at, I would strongly encourage you just ignore movements in pricing over those time periods. In the short term, the prices of stocks are susceptible to bad news. Let me show you what I mean. This is the view of the S&P 500 over the last 6 months. As you can see here, it was ticking along nicely and then something rather drastic happened. Now that looks awful on a graph over 6 months. You probably guessed that that dip there is a result of the virus affecting everyone's lives at the moment. Now on a 6-month timeline, it looks disastrous. But if we go out to the maximum view over the last 30 years, you'll notice it barely even registers. We can do this for all of the events that have rocked the stock market in the last 30 years. So here is the virus. Here is the global recession that occurred between the years of 2008 and 2010. And here is the dot-com bubble. And finally, here is the famous 1980s market crash. The important thing to pay attention to here is no matter where you bought, even if it was at the peak of each market in 2000, 2010, and in the 80s, you will have still been doing better if you'd have just held your positions. So someone who bought in 1980 at 110.62 and held through all of the bad news, all of the recessions, all of the ups and downs of the market, would now be sitting on 2948 and 51. The saying goes, it's not timing the market, it's time in the market. Essentially, holding for the long run. In a few minutes, I'm actually going to show you how the dips in the market are an opportunity for investors like us, and why when the market goes down, we should be getting excited. But before that, let's compare the FTSE 100. What we're doing to bring this up is Googling FTSE 100. And here's the chart. Now, because the crisis that currently faces us all is a global event, I would hope that when looking at the 6-month view, we would see a similar pattern to that of the S&P 500. And there it is. That's basically because the event that's occurring is affecting all businesses the same. They have to shut, so the price of the top 100 businesses in the UK has decreased. If we go to the maximum view, we can again see a similar pattern. Here is the current circumstances that we find ourselves in. Here is the financial crisis. Here is the dot-com bubble. And here is the market crash of the 1980s. Again, if you'd have bought in the 80s and held throughout that period, you would be doing very well today. Even if you bought at these peaks here, your money would have more than recovered since. So now we understand what the top investor in the world recommends we invest in and why he tells us to do it for the long run. Does that make sense? Yep. So before the final question of how do we actually invest, the last thing we need to do is develop an investment mindset or strategy. Think of this as our own little set of rules that we follow so we don't fall foul to the emotional roller coaster that is short-term fluctuations in the stock market. The reality of it is, a lot of investors panic and sell when the markets drop. What I want to try and help you do is see these dips in the market as an opportunity and not a negative. I'm going to try and do that with the help of this whiteboard. In this example, this is you, and this is Mr. Market. Mr. Market sells shares, and currently the price of those shares is £10 each. Each and every month, you go to Mr. Market with £10 and he gives you 1 share. You do this on a monthly basis, always for 1 share. But then something bad happens and Mr. Market is forced to reduce the price of shares to £5. Now there's 2 things you could do at this point. First of all, you could panic that the price of everything you bought and thus the value has reduced by half. Or you could give your head a wobble and think that although the price is reduced in the short term, I believe that these goods and services that I'm buying will continue to be used by people going forwards. So instead of panicking, I now know that with my £10, if I go to Mr. Market, he's going to give me 2 shares. Eventually, things recover and Mr. Market puts the price of shares back up to £10. Now, if you go to Mr. Market with the 2 shares that you bought off him for 10, he has to give you £20 to buy them back. Without the price going past its original point of £10, you have doubled your money. This is called dollar cost averaging. We can see this example play out countless times if we go back to the chart analysis that we were doing before of the FTSE 100.
The best example of this in modern times would be the dot-com bubble. You can see here that in the year 2000, the market reached its peak. And when people realised that a number of the businesses that they'd invested in for the internet were non-profitable, the market began to collapse. By 2003, the bottom of the market occurred. And then as confidence in the markets was regained, the price of shares began to rise again. If you'd have consistently bought this downward trend, you would have profited from this upward trend here. But you don't need massive events in the market to benefit from dollar cost averaging. If we move to a 5-year timeline, we can see that this opportunity litters the market almost on a weekly or monthly basis. Now, while from 2017 up until recently, there's been no massive movements in the market, we can see that these daily, monthly fluctuations present an opportunity for dollar cost averaging. We can even do this on the more micro scale. If you look at the last month, for example, prices have fluctuated between 6,100 as low as 5,700. Buying consistently throughout these periods will have produced the benefit of dollar cost averaging. And even without the markets moving much, you can realise a profit on funds invested just by investing consistently each and every month.
So there we have it. We now know with the help of Warren that we need to invest in index funds, hold them for the long term, and invest consistently so that we can benefit from dollar cost averaging. So now it's time for the final question. How do we actually invest? To answer that, let's get back to Google one more time.
For purposes of today's video, I'm going to show you how to invest with a platform called Vanguard. They literally invented tracker funds and to this day remain the most cost-effective way, in my opinion, to invest. You can use any platform that you like. I just use Vanguard, so that's why I'm going to show you how to use theirs. So all you would need to do is Google Vanguard. It's this website here, vanguardinvestor.co.uk. Make sure you're on the .co.uk version of the website, as if you go to the American one, you'll just be going around in circles trying to figure out how to sign up. Once you're on the website like this, it's really straightforward. Just go up to the top, press open an account. Once you've done that, you'll be presented with a screen like this. And again, all you got to do is click start my application. So on this screen, it gives a few different account options: junior ISA, pension, general account, or a stocks and shares ISA. I'm going to be looking at a stocks and shares ISA today because it's the most efficient way to invest. Basically, you will not be taxed on any of the gains that you make whilst investing. I did a separate video, which I'll link in the description, on the benefits of an ISA. So if you're not sure about that, go and watch that. But if you don't have an ISA, strongly consider this option. So you would just press open an account. Okay, so this page here is T's and C's and disclaimers. You have a read through all of that stuff and then obviously proceed. On this screen, this is where it asks you what you would like to invest in. And Vanguard very helpfully arranges all of its index funds into different categories so we can take a look. So let's just have a look at a few and then I'll tell you what I invest in and why. So within these different categories are all the different tracker funds. So we specifically mentioned the FTSE 100 and the S&P 500. So we should be able to find these on here. So there's the FTSE 100. Just to explain what some of this means at this stage, so accumulation. All accumulation means that any income that you receive from the shares, so even though you're buying a fund, that fund is then buying shares in businesses. Those businesses pay their investors what are called dividends. That's the income that you receive from a business for investing in them. It's like a thank you from the business. An accumulation fund will reinvest that income back into shares, whereas an income or an INC fund will pay that out as income. Warren said in his video,
Reinvested dividends.
for that reason, I use an accumulation fund. Basically, it assists compounding as the dividends go back into the pot, help it grow, which means then you get more dividends on that higher value and rinse repeat. It just keeps growing and growing and snowballs from there. So you could go through these and pick individual funds if you wanted to. So you've got the FTSE 100 there, the top 100 companies in the UK. You've got the FTSE 250 there, so those are the next 250 biggest companies in the UK. Or you've got global versions where they've got the same types of funds throughout the world. What I actually invest in though are these blended funds at the top. If the FTSE 100 is a fund filled with individual company stocks, a basket filled with baskets, the lifetime strategy funds are a basket filled with baskets filled with baskets. I know that's a bit confusing, but essentially it's a collection of funds giving you massive amounts of diversification. Let's just flip over to an analysis of the fund so that I can show you in more detail what I mean. I'm on a website called TrustNet and it just gives me a breakdown of what's included within the fund. So you can see here at the top, Vanguard Life Strategy 100% Equity A Accumulation.
Reinvested dividends.
So this just tells us what is in that basket. So you'll see here, it gives you all of the different funds that are included within it. There's a lot of different names in there, but if we pick out a couple, you've got the S&P 500 here, you've got the FTSE 100 here, you've got the FTSE 250, you've got Japan stock market. I think a better example of how diversified this portfolio is if you look here. It gives you a breakdown of all of the regions. So by buying this one fund, you get exposure to all of these markets. Literally, by buying this fund, you are investing in the whole world. And not only are you investing across the whole world, you're investing in every different sector as well. The level of diversification you get with this type of fund is unprecedented in my opinion. Every time I buy this fund, every time I put even just £100 into it, that's spread across thousands of different businesses in different sectors in different geographical locations all over the world. I'm essentially betting that the world economy will continue to do better in years to come. So you can pick any of the individual trackers if you wish. So if you just want to invest in the top 100 businesses in the UK, you would pick the FTSE 100 tracker. Or if like me, you want exposure to the whole world economy, you could use one of these lifetime equity funds. The difference here in the percentages is the percentage of your funds that are held within equities. So the 100% equity fund means that every penny that you put into it, £100 in every 100, is invested into stocks and shares. The 80% means 80 in every 100. The rest is typically held in bonds. The reason for the varying levels of percentage is to do with risk. As a young investor, I have a long time horizon before I feel that I will retire. So you could look at, say, 30 years before I plan to retire. That means I have enough time to ebb out all the ups and downs of the market. That means I don't mind taking a higher exposure to equities or stocks and shares, and I go for the 100% equity fund. Someone who's closer to retirement may decide to opt for a lower percentage of equity so that they can essentially reduce their exposure to stocks and shares and reduce their exposure to the volatility of the market. For today's example, I'm going to look at the life strategy at 100%. Now there's two options here. You can either make a single payment of £500 or you can invest £100 on a monthly basis. Now I told you at the start of the video that you only needed £100 today. It's technically true, you put £100 in here and it will let you proceed, but it will then expect you to make a consistent monthly payment of £100. If you just want to invest £100 today, use an app like Freetrade. They have an ISA on there. There's no limit on how much you can put in, and most importantly, they have Vanguard funds on there, so you could use Vanguard's FTSE 100 fund, for example. The drawback of the Freetrade application is that they charge £3 every month for their ISA, meaning that if you only invest £100, you're losing 3% a month on that because of that cost. If it was me and I was doing it that way, I wouldn't open the ISA, I'd just use the Freetrade free version of the platform so that I wasn't eating away at my investment with unnecessary costs. From a cost perspective of Vanguard, why I love them so much is that they're so cheap. The platform itself only charges you 0.15% of whatever you have managed on it each year. So for every £100 you put onto the platform, they'll charge you 15p of it. And then Depending on which fund you buy, there are costs associated to the fund as well. The Lifetime Strategy 100% equity fund has an ongoing charge rate of 0.25%. So 25p for every £100 that I put in it. That means in total, for £100 invested on the Vanguard platform, it only cost me 37p a year. It's exceptionally cheap. I mean, if you consider that some managed funds, i.e. people who pick for you, will charge you £5 in every 100 just to make a decision and then charge you an ongoing fee going from there. So let's assume you're going to put in £100 a month so that you can benefit from dollar cost averaging, as we've discussed. You just put 100 there, or whatever you're comfortable investing. You press next, then asks you to fill out some personal details, all pretty self-explanatory. You need a national insurance number, and then again you would press next. I'm not going to do that because I've already got an account, and it will just ask you to input bank details. At that point you are set up. It takes them a couple of days to verify the account and for the transaction to go through, but they'll communicate everything that they need to over email, and then you're up and running, done and dusted. I told you it was easy.
At the start of this video, I told you that I would give you my opinion on what to invest in, how to do it, and how to look after it in the long run. The answer to that is low-cost index funds with a provider that's well established. Investing for the long run consistently on a monthly basis so that you benefit from dollar cost averaging and smooth out the ups and downs of the stock market. Any questions, feel free to comment below. I will reply to all of them. I'm Damien, thanks for watching, and I'll see you next week.